And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. Stock prices are trending down. Bond yields are trending up. Stocks are entering their seasonally strongest period of the year, but many investors seem content to clip 5% yield on Treasury bonds and leave the stock market alone. What's the investment outlook for the rest of the year and into 2024? Let's talk with Rick Reeder. He's the Chief Investment Officer of Global Fixed Income at BlackRock. He's also the head of the BlackRock Global Allocation Team. He runs a lot of money, folks. So here's the question. Thanks for coming on.
Thanks for having me. Appreciate it.
There's one topic dominating everything here, and that's the direction of interest rates. You knew I'd start with this, right, folks? Are rates going to be higher or lower towards the end of the year into 2024?
Yeah, I mean, listen, I think we're close to the top end of the range. I mean, is it possible if growth continues to be strong and we push up a little bit? Listen, I think the one thing that's usually important is that the Treasury's got to issue a tremendous amount of debt. And, you know, every week we're getting $400 to $500 billion a week of debt that's coming into the marketplace. So, you know, you got to absorb a lot in the markets. If, you know, I think the Fed is pretty much done. Could they hike another 25 in December? Possibly. But I think short end to intermediate term interest rates have done virtually all they're going to do. Could long end interest rates drift a bit higher? I think so, because of the amount of debt that the Treasury has to put in.
So we could get a normal yield curve.
I think we're going to get a normal yield curve. As you get into next year, growth is moderating, inflation is coming down. We think as you get into the beginning of next year, you're going to get inflation in the high twos, 2 3/4, 2.85 or so. You know, it's still elevated. But if you take real rates, so you think about, you know, you're issuing Treasury bills at 5.6%. You get inflation at 2.70, 2.80. You talk about real yields that are pretty darn attractive.
Close to 3%.
Right. And I think what's going to happen is next year the Fed, to keep real yields at a restrictive level, they'll still have to bring the rate down because inflation is coming down. So, listen, I think particularly front to intermediate term interest rates, I think that we've seen most of what we're going to see there.
You know, later on today, we're going to get the Treasury refunding schedule at 3 o'clock. When was the last time this was news? And yet, now it's news. So I think we're expecting, there was huge numbers. As Rick said, there's huge amounts of debt being issued. I think it was $1 trillion in the third quarter. I think that the estimates now, they're going to announce this today, but I think $825 billion or something is the numbers. And we're actually paying attention to this, and we never used to.
So if you take gross issuance, in November, I think we're going to see $2 trillion of gross issuance. Think about that, $500 billion a week of gross issuance. So that takes Treasury bill supply and coupon supply. The numbers are staggering. And by the way, it's not like they're going down. Because of the cost of the interest now, and people don't factor in, do you know for the last 10 years, the average interest rate on bills was 0.82%. We're going to issue bills this week at 5.60. So think about what's happening. The debt service, the cost of Treasury grows. What happens is you have to issue more debt. And so this is a big deal for going. I mean, $2 trillion a month of gross issuance, $500 billion a week. The numbers are staggering. It's part of why I think rates will stabilize here. I think you need to see the Fed start to bring that rate down, which I don't think will happen in the second half of the year. But you know, we're going to get to buy these yields at these levels.
So the supply is staggering, but the demand may not be. But the Chinese apparently are not buying as much as they used to. The Japanese are not. The banks are not, for whatever restrictions. Who's buying all this stuff?
By the way, so you hit the two of the big ones. You missed one. The Federal Reserve in 2020 bought $2.5 trillion. 21 they bought $1 trillion. Fed's not buying, they're selling. The banks, like you say, not buying, they're selling. And actually, I would argue international is net selling. Who buys it all? What has to happen, and I think what will happen over the next year or so, is households will increase their holdings. So they're buying bills today, clearly through money market funds and outright. What I think will happen in the next year or so is if Fed starts to cut rates, people say, gosh, I want to lock these yields in. Then I think people will start to go out the yield curve, and you'll start to see the households have to buy it. But that has to happen. Because, and by the way, same thing with agents.
Or rates are going to go through the roof.
Or rates can go higher.
Yeah, so all those equity investors sitting on the sideline collecting 5% Treasury bonds right now, yields right now, it's a huge competition for the stock market. As a stocks guy, that worries me tremendously. But you're saying that could be good news, though. Here, what would entice them to come back into equities, though?
So I think
is this a permanent feature?
So no, I mean, listen. I think what happens. I think the equity rates still do okay, as long as rates stay here and or start to come down. If you believe that the Fed is going to start to move rates down in the second half of the year, if you think the yield curve can normalize, you could create a decent tailwind for the equity market. Listen, I think equities, if you said next year, what should my portfolio look like? By the way, you can get 5.5% in Treasuries. If you want to take a little bit more yield curve risk, go out to 3 years, 5 years, which I think is fine today, and maybe I'll do some investment grade credit, maybe you can get 7. So I get 7 in high quality fixed income. I think equities can get you an 8 to 10. You think about what return on equity for equities is 8 to 12%.
Yeah,
Multiple
that's historically,
is not that
but
bad.
a lot of people are saying it's not going to be the same going forward because of the competition. That's part of the problem.
Right. So are we going to see 25% returns in equities? I don't think so. But I think equities will do their job. I think the multiple will stay relatively unchanged. You know, can you throw off 10% growth of book value of equities? Listen, I think people will continue to buy equities. I'm pretty blown away. You think about U.S. economy this quarter grew 4.9%. That is staggering. That is the direct relationship to revenues for companies. As long as we can keep growing nominal GDP in this country, equities will do their job.
And where are you in the soft landing camp? We've been waiting for this recession for a year. A year ago, everyone was sure we would be in a recession this time.
Yeah.
Wrong, completely wrong.
I don't really get the concept anymore of landings. Like I think the world likes to talk about soft landing. The U.S. economy is 70%. Consumption is 70% services. In 100 years, there's only been 14 negative quarters of negative growth in services. Services don't have cycles. Goods economy has cycles. When people say, gosh, we're going to go into a recession or deep recession, you'd really need the goods economy under tremendous pressure. The goods economy can be cyclical, commodity-driven, commodity-oriented. But I just don't, do I think, so this year we think GDP, real GDP, we think will finish at 2.5% real. Next year, we think it's going to be 1.5% positive. So moderating, slower, but I think people underestimate. I call the U.S. economy the polyurethane economy because it flexes, it adjusts like a Tempur-Pedic bed, and it can take some pretty significant shots, and it rebounds. So I think we're slowing.
I love that polyurethane. So not Teflon economy.
No.
You're sort of playing on words here, but polyurethane.
Yeah. So I said that before.
It bends
it's incredible.
And flexes.
Yeah. So there was a commercial once. I remember the Tempur-Pedic bed. They showed somebody jumping on one side of the bed, and they didn't spill the wine glass on the other.
Oh, right.
And that to me is like the U.S. economy. You can take commercial real estate, local banks. You can take an incredible increase in interest rates. U.S. economy, technology-oriented, energy-independent. Real productivity and innovation taking place, and a service-oriented economy, particularly as the population ages. You think about spend on healthcare, spend on education, et cetera. It's much more stable than, people talk about these cycles. I think cycles were something we saw 20 years ago, 30. Unless you have a pandemic or financial crisis, I think it's much more stable than people think.
Now, active bond ETFs. You've got this active bond ETF. One of the reasons I wanted to have him here, other than get his macro, is he's running an active bond ETF right now, and they're having a bit of a moment, these things. You launched this BlackRock Flexible Income ETF, BINC is the symbol. You started in May. It's got 160 million in assets, and that's pretty respectable. You're the manager of this thing. So I look at this. Two things stick out to me about this. This is a very unusual ETF, folks. Strong emphasis on international. I see Brazilian bonds in here. I see Mexican bonds in here. Generally emphasis on the shorter term. I think a 3-year duration.
Yes,
is that right?
2.3 years.
Okay.
Yep.
Tell me about international. This really leaped out at me. I see almost 40% international. Why international bonds?
Yeah. So by the way, there's international and international. So when you think about emerging markets, you could be hanging out on the edge in Argentina and Turkey and historically Russia, et cetera. We like Mexico. Think about where short-term interest rates, local rates are in Mexico. You can clip double-digit yield to buy short-term Mexico as long as you're comfortable with them. We hedge some of the currency. Brazil's a high-quality emerging market issuer, but the size we have in emerging markets relative to where we have international is much bigger in Europe. So things like European investment-grade credit, European high yield, a dollar investor today, because of the currency, can actually swap back. So as a dollar investor, what we do is we swap back things like European investment grade credit to dollars. You get 6.5% for 2-year good quality investment grade companies.
So this is largely it's a dollar play to a certain extent. It seems like
by the way, we could be here a year from now and we'll be 15% international. Today, it is such a boon to U.S. investors to take advantage of this.
Because of the dollar.
Yeah, by the way, it's the flip side of a European or Japanese investor. You can't buy U.S. assets because the cost to hedge your currency is so expensive. But as a dollar investor, it is a windfall. The beauty of this active ETF is we can move around and take advantage of where the opportunity is. I think, active ETFs in fixed income, people underestimate. There's 68,000 securities in fixed income. I know we were talking earlier about the size of the equity market, the number of issuers. There's 68,000 fixed income. I think the stat is 85% of active managers outperform fixed income. One, you get carry and income. Two, you have such diversity of opportunity. You know, what we'll do in this that I think is hard for an individual to replicate, we'll do things like securitized assets, things like asset backs, CLO, but we'll keep it real high quality. Our average rating, I think, is low single A now.
Yeah.
And we're getting,
well, that's what's unusual about this. First off, 5 3/4 yield on this right now. That's above 2-year treasuries, right? And what's the expense ratio? 40 basis points, I think.
Yeah,
right?
we're significantly higher yield than that. Under but we're actually over 7 in terms of the way we're at 7.4% today. So it's a pretty good yield in the portfolio today.
So I see here, non-U.S. credit 22%. Those are like international bonds.
Correct.
Mexico, Brazil. U.S. high yield 17%.
Yeah.
That's pretty high. That's going to be a little help there.
Yeah, there's one thing when you categorize certain, like we buy a lot of high quality issuers, and we do an awful lot of analysis in terms of the types of issuers we buy. And like I said, like international things like European investment grade is pretty safe. The nice thing about this, we're getting 90% of the yield of high yield index, and we're half the volatility. Like if you go back since we launched this in May, our volatility is really low. We've outperformed the aggregate index by 500 basis points since we launched.
Is that only because you buy the highest quality junk? Or is that
we buy some high quality? We buy a lot of high quality, high yield. We buy a lot of high quality asset backs. We buy a lot of agency mortgages. And because of, like we talked about earlier, the shape of the yield curve, you can buy a lot of yield in the front end of the yield curve today. Keep your yield really high. Keep your volatility down.
Yeah.
And we don't own. I'm going to say if we don't own anything, but I'm pretty certain we don't own anything longer than a 5-year maturity. Right. So our interest rate volatility, say the ag, since we launched, the ag's down over 4.5%, and we're up since we launched. And the idea is keep your interest rate volatility down, keep your volatility of credit down, and just try and do it over and over again.
And I see asset-backed securities here, 8%. I mean, that could be what? Credit card portfolios? It's anything backed by assets,
correct.
Right? Credit cards, car loans, whatever.
Student loans, auto loans, I say credit cards, residential mortgages. You know, we like parts of the AAA commercial mortgage market. People have said, you know, office property is having a problem. It is. But we like parts of the commercial mortgage market.
And you have commercial mortgages in here too, 7%.
Correct.
So how do you put this together? I've asked him several questions about its construction here. Do you use top down, bottoms up? I mean, how does the model, do you look at the global economy and say this, and then you say you have all these tens of thousands of bonds? Is there a bottoms up way to do that too?
So, you know, we run $2.6 trillion of fixed income, so we're pretty active in the market. The way we do it is we set regime identification. So I spend tons of time on the macro and saying, okay, where are we today in the interest rate? Where do I want to be in the short end of the curve, long end of the curve? Do I want to be international? Do I want to be domestic? And then we let our teams do the bottom up. So I'll say to our securitization team, I'm looking to get this yield. I'm looking to get this sort of dispersion, this sort of volatility. I'm willing to take this sort of volatility. Go get me the best assets for it. And then we let our teams do bottoms up. And you know, the intensity of what we do, we have unbelievable risk systems. We run stress testing, scenario analysis. I think we run 350,000 simulations a night to try and look at the stability and make sure, you know, not to get too technical, things like correlations, dispersion, beta is in the right place, and it takes some pretty serious analytics to get it to the right place. But we start with identify the regime we're operating in, where's the best opportunity, then let our teams go find the individual assets.
Yeah, so now let's just talk about how well they're doing on this thing.
Right.
Okay, so what you launched in May. So the benchmark is the AGG. And for those who don't know, the AGG is it's sort of a basket of the most diversified stocks and bonds, fixed income that you can have. So you've got high yield, you've got corporates, and here you've got treasuries, right? So this is sort of the benchmark. So there's the AGG on the white line there. You move that again, put that back. We have the AGG on the white line and the BINC there. And you've been outperforming, which is actually it's hard to outperform on fixed income. They can be.
I don't know. I mean,
well, actually, you have a very unusual mix here of stuff.
Because we can build income.
There you go. That's what I'm looking for. Thank you. Last few months, the orange line is the BINC, which is Rick's fund.
By the way, that number, I mean, that's 500 basis points. So and the volatility.
And that's only price.
Look at the line.
You're just doing price here too, right?
Yes, sir. And we yield more than I think that's the ag.
Yeah,
but look at how stable the orange line is versus the white line.
Yeah,
and so what we're trying to do is create, you know, really low volatility, very low dispersion, and keep our yield up so you clip in an awful lot of income, and then use our tools to manage the diversification of it.
Yeah. BlackRock also runs iShares. I mean, this is the largest ETF provider in the world right now. But that's mostly passive investments, right? The iShares part. This is actively managed here. So where would this fit in a world that's largely moving towards indexing? I mean, can you make some argument that active management bonds actually has a better proposition for outperforming than actively managed stocks, for example? Is there something about bond investing that makes it more amenable to active investing, or is that not true at all?
So there's two things in fixed income that make it very, very unique. One is the secret about fixed income is if you can build more yield in your portfolio than the index and kick out the stuff you don't want to own. So, I mean, you can create 50 to 75 basis points a year. Things that trade too rich, things like agents, like some of the agency paper, some of the supranational paper, trades too rich, kick it out. Get more yield than the index, and then manage your volatility aggressively. And then the second thing is the point I made earlier. There's 68,000 fixed income securities. Your ability to pick the ones across that make sense for.
So you're saying the plethora of CUSIPs is what they are. They're the individual names is how they number them. CUSIPs. It enhances the possibility for you to win in active management.
Correct. I mean, to think about, we'll look at a piece of commercial mortgage security, and we'll look at all the collateral, and we'll say, okay, is there residential in here? Is there how much office is in there? Is there warehouse in there? And then we analyze it, dissect it. It takes a lot of rigor. It takes a lot of analytics. But you do it over and over again, you know, similar to the way, you know, casino operates. Is if you can tilt the odds in your favor, just do it over and over and over again.
Well, the increase in choices strikes me as one way you could outperform. It also has the potential for underperforming because you get overwhelmed by the sheer choices.
It does. So I run an opportunistic mutual fund. It's called Strategic Income Opportunities. We've run 1 year, 3 year, 5 years. We've run double the return of the aggregate index at half the volatility, and it's because you have so many tools at your disposal around the world, like you were pointing to. You know, there are times you want to be in Mexico. There are times you want to be out of it. There are times, you know, being tactical in fixed income and having expertise and real teams around the world to do it can be hugely effective.
How do you compete with the onslaught of these active products I've seen? I've covered so many of these option overlay products that are out there, all sorts of things that I have seen, option income strategies, covered call ETFs, enhanced option ETFs, premium income ETFs. You know what the competition is like, and they've attracted some interest. How do you compete at that against?
So listen, I mean, I've been doing this for a really long time. We run a lot of fixed income. My view is just try and create durable return, consistent return over time. The reason why I think this BlackRock income will grow significantly. The desire to own ETFs and models, but to also understand how will that ETF do. So if I put in what most financial advisors say, gosh, I want to build a model, I want to understand what that is. The transparency around this today is, gosh, I know I'm getting income, I know I'm not getting a lot of volatility. That will fit an awful lot of models. It's why you've seen it grow as much as it has. It grows so much in the last few months. And our sense is, as more and more platforms put it on, which we've seen recently, that it'll get some real growth. Like I say, because it fits. Like, how do you get, people buy yield because they like high yield, and there are not that many tools to do it. Being able to find a tool that somebody can manage that higher income with some stability, I think will gain a lot of attention.
A lot of people are saying this increase in rates. I want to go back to the macro as we get out of here. The increase in rates has done the Fed's work for it. Is that your position too?
I think it's a big part of it. I mean, I think part of it's the long end of the interest or the yield curve that's moved up. That tightens financial conditions. That's where most of modern finance issues, corporates issue out the longer end of the curve. Mortgages are issued out 5 to longer on the curve. So the fact that we've moved this much and we've moved the forwards, not to get too technical, but if you look at the forward rate curves, they've moved back 160, 170 basis points. That is a huge move because people were expecting the Fed to hike and then start easing quickly.
I think a lot of people were baffled why the long end did move, but this has historically been a problem. The Fed raises short-term rates and then the long-term doesn't go up enough, and everybody says, why isn't everybody listening to us?
Well,
but now
it
is.
And it also helps that Treasury's now issuing it a lot, and so you're getting a lot of supply. And to your point earlier, parts of that where the traditional buyers aren't there anymore. So we're getting some curvature. I think you'll get more normalization of the yield curve. Part of why I like owning the short end to the belly is I think the yield curve will steepen.
I know you're the fixed income guy, but I'm the stocks guy. What's your outlook or BlackRock's outlook for equities? The S&P's gone nowhere for 2 years, essentially sideways. Here, Europe still underperforms. Global equities?
So I run a lot of equities. My global allocation fund's big, is oriented towards equities. So listen, I think equities will do their job next year. I think, I prefer U.S. to Europe. I think Europe's slowing faster. I think the multiples in U.S. are actually, if you take out the Magnificent Seven, although actually I think those stocks are okay because of their revenue growth, but if you take them out, your multiple, you can find a lot of stocks trading at 3, 4, 5 times cash flow. I've learned in my life, if you can buy companies, stable businesses at 3, 4, 5 times cash flow, that's pretty darn attractive. There are places like Japan that
are there companies like that are doing that? You can do that now?
100%. So you look at parts of healthcare, autos, defense, home builders, energy. There's a bunch of them.
In the last couple of months, they've gone into that territory. It's taken that much time.
Totally agree.
That does it, folks, for this week's ETF Edge. This has been great, Rick. Thank you very much. We've asked Rick to stick around just for a couple of minutes to chat a little bit more about international investing, the ETF Edge podcast coming up. And remember, you can see all of our shows on the website. It's etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.